Hello everyone. Through our current series, Bridging Generational Gap, we aim to decode some difficult dinner conversations for multi-generation wealthy families. We have Mr. Sanjay Mehta, who's founder and partner of 100x.VC, to understand his view on, what is the best way where the family offices can participate in exciting deals. Uh, Sanjay is a veteran in the startup ecosystem. He's a serial entrepreneur, and of course, he will talk about his background. Sanjay, thank you very much for taking time and joining with us on the series.
Hey, thank you, Amit. Thank you for having me.
So, Sanjay, I'll also like to add here for our audience that Sanjay has been one of the first Camden Club members. He's completed 5 years. When we launched Camden in India 2016, Sanjay was happy to come on board and support Camden in India, and he has been with us, loyal. And I would like to thank Sanjay in this series. Thank you for seeing value in Camden. So Sanjay, you are you know everything about startups. You have been there, done there. So what has your journey been in the system? Were you always into the startup system? How did you get involved? Uh, uh, so just a bit of about your background and what you do.
Sure. Thank you, Amit. And it has always been a pleasure to be part of the Camden family. And thank you for having me as a member and inviting for this talk. When I finished my engineering school, I always wanted to become an entrepreneur. Right? I never applied for a job, so started a bespoke software company, built it to a level. Then had a short stint in US, saw the dot-com story happening in US, came back, started a dot-com venture, and lost all my money with the roller coaster ride with dot-com burst happening. It was very painful, but it was quite enriching to see the highs and the lows of becoming an entrepreneur. Then had a company called Udyog Software India Limited, which I built it to a level with almost like 20,000 odd customers, sold it to a US-based company called Ediquare. The founder was Indian, wanted to come back to India, wanted a vehicle, so ended up exiting Udyog with Ediquare. Then had a company in business analytics called MAI Intelligence, which Datamatics acquired. So, building companies, building products was something which I loved across. And as usual, once you have an exit, you end up investing in various asset class. While regular investments were happening, my first exposure to alternatives started with Aditya Birla Private Equity, where I invested as an LP. And that's where my journey began. But it was more of passive investing, nothing active. Then Harish Bhai, who is the founder of NASCOM and Onward, he introduced me saying that because I was a technology person, why don't I join angel investing? And that's where my first brush with angel investing started. And being a techie, I could manage to get attracted to a lot of the tech deals evaluations in the space. And then the journey began, and it just got exciting over the time. And the way the various ideas came up. So since 2011, investing personally into startups. So that's how the startup journey started.
Exciting. What, as far as I know, you probably invest only in private deals from as a portfolio, or you are investing into public markets or bonds and debt and other asset classes?
I have no clue on the listed side of it, but yes, family does across. My father and uncle both are very active investors in multiple PMS, or they also do active investments in equities. So yes, but I personally have been only focused on startup because this is the only asset class which I believe where I can influence an outcome. If I invest into any other asset class, be it real estate, commodities, you just buy and wait and watch the price to move up and down. Whereas startup is one place where you invest and you can actually work with the founder and influence an outcome. So this is something which excites me.
Entire portfolio or wealth of your family, you would say like 25-30% is in private deals and startups, or
I would
more?
say around 10%.
Acha, 10%. Okay.
We would be we are tilted more on the real estate and listed equities.
Okay. So that's interesting because uh, since we've been meeting on Camden platform so often, that I always believed you would be only in startups. But so you are 10%, which is what we would be, or any family office would be today. Uh, 8 to 10% is what normally we expose to private deals and startups. So that's an interesting data point. How things have changed since then, since the last 10 years, since you've been investing, in terms of where do you find the right deals, and how does an investor who is not so much active get the best deals? So what has been, what you were doing and now what you do, sort of a bit of journey in that.
Sure. Amit, you yourself have been an avid investor actively participating. So you would have seen across the way, the landscape has transformed itself. The founders, what we used to see in early days in 2010, 11 kind of, today founders are very mature. They understand the whole journey, startup life cycle journey very well. The opportunity is everywhere. And India being such a large country, you blindly throw a stone, you will find a problem, right? So everywhere there are opportunities. So and it's just happening in every nook and corner. Today, there are incubators which are there in the colleges. Every possible college has got an e-cell. Previously, colleges used to flaunt across their employment saying that 100% of our students get placed. Today they are proud to talk about entrepreneurship, saying that okay, we created X number of companies, this are number of startups which we worked across. And I think the whole game has changed in a crazy way. And look at the number of unicorns which are getting produced in India. So I think things have changed. Number of investors has grown. Domestic capital is now flowing in India. A lot of corporate venture capital. So big corporate houses coming into VC space. It's very heartening to see across. Definitely media has made it glamorous, no doubt on it. But there is a merit to it. Today we have got so many deals which are happening. It's just unbelievable the kind of momentum what I'm seeing in today in Indian market. And this is not going to stop. This is unstoppable. Come 2030, you will see across at least in the top 20 companies, you would see at least 5 of them would be the venture funded companies in India, the top corporates. IPOs are coming fast and thick. And this is the best time possibly what I can see across for founders and investors both alike.
Interesting. I 100% agree with you. There's a lot of activity happening in this area. So for family offices who are, probably not tuned to go about investing in startups, what is the way you would advise, for family offices? How do they participate in this startup ecosystem?
First and foremost, I've got if then else kind of chart. So for example, if you have time and energy and ready to do the hard work of engaging directly, then you can go direct. If not, then it's best way to do a blind pool fund investing. It's better to give to a fund manager who will take a decision on your behalf,
Mm.
right? And where you can do smartly. Let me just pick up the fund side of it. Let's say, for example, you are investor in a fund. The smart things which you can do across is you commit to a fund, but ask for a rights so that you can co-invest with that fund guys, right? And even if you're not investing, keep that right. And you may invest through companies or use or create a syndicate to invest across. So you need to structure an agreement with the fund manager so that you can have that pro rata rights. And select the fund manager, check his credentials, past performance. Even if, let's say, it's a first time fund manager, they would have some track record with startups. So how did they perform? Talk to a couple of portfolio companies. So that would be one side of it, how you end up doing. Second is, you want to go direct. Working with startups is very exciting, but it consumes a lot of time, energy. You need to source deals. So let's say if you get random deals, which means direct on your email, LinkedIn stuff, typically let's say you see 500 deals, you will possibly take 50 meetings and end up doing 5, which is not worth your time. You may possibly get some validated deals, which are more from investment bankers or wealth managers who will push you deals. But they have a conflict, right? There is a conflict because they are earning fees on that. So you want to be very sure. If you're looking at 100 deals, you may do 20 meetings and end up doing 10 deals. But the best deals are when somebody is referring a deal, saying that I am investing money into this deal, and there is no conflict. Somebody's skin is in the game, and they are saying that why don't you join the pool, right? And those are the referred deals. And there are lots of syndicates which are there with family members. Camden family also does share those deals. I mean, that's how the best advantage which happens across. There is no conflict, there is no earning on that, but it's more of saying that let's jointly build the whole pool and try to invest and discover startups. So it's more of trading of deals, which happens where you might just get 50 possible referred deals. You might end up meeting 25 of them and end up investing in 20 of it, because it is a valid deal. And Camden does a co-investment workshop also, which is a great way to promote the deal. So I think that's how most of the families should be looking at investing into deals. And if you've got a next gen who is young, happening, and trying to learn across what's happening, this is possibly the best MBA school what your young kid can get across. Amazing learning. It's just, I mean, the kind of people you will meet across, be it from an investor side who is as a co-investor on the cap table, to the founders. It's the whole journey is just amazing.
Agree with you that co-investment is been the best. In our cases, we have invested because of it has been a referred deal, and we know people investing. There have been unicorns happening, every month practically, and a lot of the family offices, including sort of me and you, would like to participate and make higher returns by getting some shares in the unicorns. And I've been seeing a lot of trend about this pre-IPO funds which are happening. How good it is to invest in these unicorns. What are the ways, and and how long do you think this trend will last, where you can make multifold returns?
See, my take, Amit, would be to when you are doing pre-IPO deals, most of the value what was supposed to be created is already created by the private investors or early stage or angel investors. So what you are doing is possibly taking a risk of a startup, and you will get returns of a listed equity. When you invest in a startup, your focus has to be minimum 20x return. Now, you think across whether this will, that unicorn, will it be 20 times as big and give you that return? Possibly no, and very rare exceptions which will happen across. So my take, why you are investing in this illiquid asset class is because you want higher return, right? And failure rates are high, but that one mega outlier hit or success is going to give you that. So it's all about power law, what I talk about. So my take would be to start early. That's the best time, and possibly these are the great times. Like we are in 2021. Next 5 years of investing will pay handsomely to most of the startup investors when these startups will grow and start doing IPO from 2025 to 2030 onwards. This is like a great journey, right? Next 4-5 years, get early into those startups, create a portfolio of, if you do one or two, it's like buying lottery. You need to have at least a portfolio of 20 startups at early stage, and I'm sure you will see across success with one or two within that 20, which should give you a very healthy returns and much better than what a public listed market would give across. In startup world, if I have to put a sentence, your capital risk is 1x, upside is unlimited. That's how I would say across.
Okay. So it's an interesting, observation. As you rightly said, you will probably get a 4 or 5x, from where it is. So today, if you invest in a unicorn which is already $1 billion, it will become $5 billion. So you will get a 5x. So there's no point in investing in one or two startups.
Not at all.
Right? Because it has
That's
no
like
meaning.
buying lottery.
Yeah, you should sort of go for 20 to 25 startups. Very, very good observation and good advice for family offices. And I thank you for that. So we move on to the last section where we will do a rapid fire with you, Sanjay. So first is the top 3 things you look for in an idea pitch.
So for me, first thing what goes in my mind is there money to be made? Then I look at the team and their background. Are these people who can make me money? And whenever I see across their terms of investment, financials, how much money I can make. So 3 things: is there money to be made? Are these people who can make me money? How much money I can make? So that's a 3 tick in a box, and you invest.
Okay. 3 startups you are betting on which will join the unicorn.
In my personal portfolio, CoinDCX, which is a crypto exchange, which I believe has got a great story. Second one is Coolberg, which is a non-alcoholic beer drink. And third one is Wangi, which is a neo-banking app which is coming up. So these are 3 from our family Mehta Ventures. On 100x, I would say across, I believe Smiles.ai, which is a dental chain which is there. Pocketly, which is a micro lending platform for loans. And third, which I believe is a great story, is Philo, which is a tech company. So that's how I would say. These are 3 each, which I believe has got a very strong run.
A message for founders.
I would say across, whenever you hit a big idea, before you spend your precious months and years, do the validation. You will get everything right, but if there is no customer, or you are building which nobody wants, the whole idea will get flopped, right? So do a idea validation before you spend your precious months and years. That's the biggest proof that you're building a product which somebody wants.
One investment you are proud of and one investment you regret missing.
I've invested in a microdialysis chain called Renal Project. I'm very proud of, because it's a huge impact and the business is also making money. So I've never seen this double bottom line in such a big way, where it is making money and giving so much impact. So Renal Project, that microdialysis is one which I'm very proud of. And I regret across, I've got multiple NT portfolio, but one which I regret the most is a company called WizRocket, now which is called CleverTap. It was an early bet. I engaged very closely with them, but the founders were having a distributed team. One founder was in SF and one founder was in Mumbai, and this was 2015-16 kind of stuff. That time distributed teams were not as much favored across. Right now it's a norm. So I lost that deal to Excel Partners, and today it's becoming a unicorn.
So, Sanjay, thank you so much for sharing your thoughts, insights, and your advice for investing in the startup ecosystem. There's great learning from you for our audience and for all our Camden community. To summarize, I think what you said was correct. That if try to be active as far as possible in the startup ecosystem, build a larger portfolio of 20 to 25 companies, start investing early at seed or angel stage to get maximum returns. Look at co-investments as a correct medium where you have the idea already validated by other investors, and overall 8 to 10% would be a meaningful allocation from the overall portfolio for private deals and startups. And you believe that unicorns are going to be made for the next 5 years. It's just the beginning, and we are into a phenomenal stage here in India where it's a trajectory which is going up, straight curve. So once again, thank you, Sanjay, and the Camden community. Stay tuned for such candid discussions with more Camden members. See you next time. Till then, take care. Be safe.
Thank you. Thanks, Amit. Thank you.
Bye.
Bye.